Good morning. My name is Idrach, and I'm going to be your facilitator for lesson number 4 of the Wilson County Library Seminar. Okay, good afternoon. As you all know, we're on lesson number 4, and we're going to start on this lesson with what is beta. Beta is very important, and this is where we, in lesson 4, transition from reading charts, stocks into options. So let's take care of beta first. It's part of the stock. It's something that is very important for you to understand that beta is a measurement on the stock that determine, how the stocks behave against the S&P 500. And that is important, how it will behave. Is it follow through? Is it follow with the rest of the market, or is not following with the market? So some stocks are trade at much higher rate than the S&P 500, and others kind of laggard, they trade below the performance of the S&P 500. So it's very important for you to know this, because when you're going to buy the stock where you want it to probably that behave better than S&P 500, because you can make a little bit extra money than the average, and this is how you can outperform the S&P 500. If you buy a stock that is not in performance like that, and it perform below, so then you always will, your investment will be below the S&P 500, and that's actually what it amount to. This comes with some drawbacks and something else. It don't predict the future, so this is not set in stone. So you got to remember that it's not predict the future of the price. All the data is based on previous performance. All the data comes in from previous prices. And of course, as I said before, nobody have a crystal ball. So with that, let's move into this lesson. And let's look at a definition of beta. You don't have to understand it. It's already figured out for you. And I'm going to simplify in a simplest form possible that's what it means. So formulas, it don't really matter, but at least you understand what they're for, and it's either an indicator or a number that tell you what that is. That's all you need to know. So with that, let's look right quick into that and see how this is going to work out. Okay, here we are on the description of beta. So I'm going to take a little sip over here with my soda where I do the class over here. So beta is a calculation that goes as follows. Let me show you what it does. We take these numbers here, or this formula, which is R, the return on an individual stock, and RC right here, RM here, equal the return of the overall market. What percentage of profit, how well it's returning. And then the covariance is how to change the stock in returns are related to the change of the market. So they take the relationship between the stock market and the stock, and it's divided, you got RE, RC, and RM divided by RM again. So actually, this is what they come out with a number. So they assign the numbers 1 as S&P 500. So that's kind of a fixed number. S&P 500 is 1, and the reason they use the number 1 is because you're going to be either above 1 or less than 1. So it's more than 1, greater than, or less than. That's all these algebra formulas and stuff like that. So the beta calculation is used to help investors understand whether a stock moves in the same direction as the rest of the market, it also provides insight about the how volatile or how risky a stock is related to the rest of the market. So we're going to cover all the volatilities too, because volatility also we have it on option, and that's where we're heading to. So they kind of marriage together into this thing. For better to provide a useful insight, the market that is used as a benchmark should be related to the stock. Remember, what you're going to use, you got to be related to the stock. So if we're going to do a stock that is listed in the S&P 500, that's the larger market, or we're going to do a stock that is listed on also on the Russell 2000. So then I guess we could use Russell 2000 as number one. This is one of the 30 stocks that is listed on the New York Stock Exchange or the Dow Jones Industrial. Then we can consider that as one. I normally don't worry too much about that. What I do, I just take the number from the S&P 500. And that covers enough in the market to determine how well it performed. For example, calculating a bond ETF beta is using the S&P 500 as the benchmark. You see, so now we know that bonds, exchange trade funds, they also use the same S&P 500. Will not provide much help insight for investor because bond and stock are too dissimilar. You see, so we can tell here that calculating a bond on a beta ETF is not going to be the same for the simple reason that bonds don't behave just like the stock. So if best you're going to do stocks, you do the S&P 500, and ETF, it got too many. It might be stocks that might be on the Russell 2000 listed also, so it kind of mixture on it. So it's best for the single stock. Ultimately, the investor using a beta to try to gauge how much risk the stock is adding to the portfolio that you own. While a stock that deviates very little from the market doesn't add a lot to the risk, a portfolio that it doesn't have increasing potential for greater returns. So what they're saying is that the stock that deviates very little from the market doesn't add a lot of risk. So the closer you are to one on the stock, to that one for the S&P, the less variance is on the price of the stock as the market behaves. So if the market go down, your stock going to go down with it, period. It's just simple like that. So S&P 500 go down, you're going to go down. But by how much is the catch here? This is the risk. And we're going to cover this here, So it also doesn't increase the potential for greater return. So it's kind of catch-22. If you have a stock that is higher than one, it's going to gain more percentage of the market because of that. But at the same time, when the market goes down, you're probably going to take a bigger hit too. So, and those things will happen. There's a saying that say that when the tide go down or ship go down, well, the same thing applies for stock. When the S&P 500 go down, a lot of stocks going down. When the tide rise, not all the ship rise. Okay, the same thing happened with S&P 500 and a stock. When the S&P 500 go up, after the drop, not all the stocks recover. And a good example of that is MGM. MGM back in 2008 was $105 a share. And when the market crashed and lost 50% of the market, it went down to 8,000 points. MGM ended up 6 months later, 3 months during the market going down, about $3, $2.50 a share. Today, 12 years later, the market is about 30,000 points higher, or 22,000 points higher than 2008 crash. but MGM is still about $23, $25. So you see, there was a ship there, one of the vessels that didn't make it. When it went down, it never came back up. So not all the ships go down, and then some, when the markets go down, just like the tides go down, that all ships go down. Well, a lot of the ships get wrecked on the process, and they never float again. The same thing happened with the stock. And we relate to that because it's so secure and so interesting that they both kind of go hand by hand. So getting this out of the picture, let's go and look at Beta over here. So here we have a stock that is $274.50 a share. And this was about 4 o'clock after the market closed. It was higher than that during the day, as you can see. And the previous close was $272. So it got about $1.63 higher. Market cap is about almost $1 trillion, $781 billion. This morning when it opened, this is important for stock, so that's what I have it here also. Even so, we talk about Beta, we'll get to it. It opened at 272. The market maker, we had talked about market maker before. The bid is 275.5, and the ask is 276.45. So the difference between these two is going to happen when you buy the stock. They're going to sell it to you at this price, at 276.45. You say market price, that's what they're going to give you, right? When you sell it, when you sell the stock, even if the stock is at 276, when you sell it, they're only going to give you 275.54. So sellers get this price, buyer get this price. The difference, this is what the market maker makes for themselves. So even so, we say there's no, we don't charge commissions anymore. It's not true. It is true that they don't charge commissions, but that difference that they have in there, it makes a lot more money than if they would have charged commission. And this is why before, you buy a stock, you buy 1,000 shares, it was $5, right? So you say, oh man, $5, that's great. $5 commission and $5 when you sell it. But then the spread there was much closer. It used to be like maybe 10 or 15 cents. So maybe when you bought and the stock is at 276, when you sell it, let's say that it's at 274.50 like it's up here, 274.50. When you sold it, they sold it for you for 10 cents less than that, 274.40. But you pay $5. Now you don't pay no commission, you don't pay the $5. However, this is $1 something per share. So you bought 1,000 shares and they got $1.40. Guess what? That's $1,400 for the benefit then. So when you buy the stock, you're going to start with $1,400 in the hole from the beginning. So your stock had to go up now $1.40 before you break even. And when you sell it, you're going to have to be way above $1 something to pay the commission going in and out. So don't tell me there is no commission, because the difference on the spread, they're making plenty of money with that, much more than before when they only charge you $5. And then it was like 10 cents or something like that. So you might only be off $200. Now you're going to be $1,000 more, with $1,400. So here we go. We get to Beta, the famous Beta. Beta, it got a special symbol. Over here they measure it by 5 months, 5-year monthly beta for this stock is 1.18. We're going to get into these numbers later, and you're going to see how we calculate this, and you're going to see how much your stock can make or how much your stock can lose. Okay? Then they talk the price per earning ratio is 31.25. Earning per share is 8.78. as of January 27, 2021. So this kind of explains the whole thing that you normally see on your stock. You get the chart, you get previous close and what have you, and so on. And then you can do some more research to buy the stock. Here's another one, right? So the previous one, it was something like $1.18. And this one is going to be what? $1.28. This company also had $2 trillion. This is a big company. The stock is much less. It closed at 136. And we already covered those, the price where it had been during the year, the last 52 weeks, from $53 to $139. Today the range had been between 135 and 139, so it's about $3 and something moved during the day. And here we go again, look at the bid and ask. Now this is about almost $1.02 different with bid and ask. This morning up at 136. And we got about 108 million shares traded. This we expect it to be higher than 134. However, the beta is 1.28. Okay, so we're studying beta, so we don't going to spend too much time on the other stuff. But here's another one. But this one here got a beta of 1.79. Oh wow, this is a good stock to buy when the market is up, because you're really going to rake in some extra money. There another one that it probably got about 2 point something, so you can really make some good money. So now let's get in this here. Here we go. Now we're going to have a stock here, and this is Ally Finance. We had talked about the stock before, and the little bars up and down. The reds are down day, up day, but the trend of the stock is up, right? It's been trending up for several months. We have mentioned before about indicators and so on, but this particular stock beta is 1.79. So here we were going to do some calculation for you so you can understand about beta. We're not interested too much on this, but I draw some lines over here ahead of time so we don't have to spend a lot of time recording this. So they've done before we repeat recording preparations here. So the stock for the last 8 weeks ago, it was $30 a share. And in 2 months, and each bar is a week, had gone up $10. So now it's about $40. It's $40 a share at this point. So we got a $10 price increase here. And we got the time value here, which is 8 weeks. Now, let's look at the S&P 500, right? We say S&P 500 equals 1, and Ally is greater than 1 at 1.79. Then is the S&P 500 move 5.71 in a week, right? So what is the price? The price should be at the stock, right? So actually, we're going to show you the calculation also right here. We're going to use a little number higher than that rather than using 179. We're going to round it off for simplicity, and this is how beta works. The formula is as follows. S&P 500, we know that equal 1. So the S&P 500 is up 10%, whatever that is, and beta is 1, so it's just plain 10%. However, the stock that we got here, Ally, the beta is 1.79. For simplicity, we put 180. So if we take 180 and multiply it by the 10% that the S&P 500 have moved up in the last 8 weeks or whatever, right? Or for the last, that's the 10%. That means that your stock will have gained 18%. So if your stock is tracking along the same way as the S&P 500 move, when the S&P 500 move 10%, your stock will gain, right, 1.8, so you're making 18%. If your stock was considered, let's say, 0.99 or 1.1, then your stock, if it went 10%, the S&P 500 went up 10%, your stock will go up about 10%. So 1.8%, it cannot give you an extra $800 or whatever, you know. So this is what happened. The stock went up 10%. For this stock with 1.79 beta, then the S&P 500 probably moved only about 5.71% in a week. But your stock gained $10 instead of gaining $5, right? Or $5.71, because it's S&P 500 moved 5.175, so you got to multiply that times 1, you know, your 1.79 against that, so it's a $10, just about $10 move, 10.28 or so. So this is how beta works. You take the percentage of the stock, the beta on the stock, 1.80, you multiply by the percentage of the S&P 500 move, and that give you that your stock should do. So before you buy the stock, you say, if I buy me a stock with 1.79 and the S&P 500 move 10%, I can double my money. It will go 20%. You know, you got a 2, it will go 20%, so you gain 10% higher than. So you're comparing among the other stock as a whole to see what good stuff do you have. That's actually what it means. So for simplicity, we're going to look at here the S&P 500 up or down 10%. Your stock that it got 1.8, it will move 18% up or down. This is the bad side of it. So when the S&P 500 go down 10%, your stock will go down about 18%. It transfers with it. So it's good with the uptrend, but it's not good when it's downtrend. So this is how actually works. We're going to show you something here, how it tracks. Meanwhile, let me take a sip over here. Or a little soda for my throat. So here we got Facebook, okay? And this is Facebook 274.50. So now we know that the chart that we saw before, it is that one, okay? The beta is 1.28. And this is the symbol for beta. So the beta here for Facebook is 1.28. We are going to overlap the price of Facebook over the S&P 500 chart. And what we're saying is that since the S&P 500 is 1 and Facebook is 1.28 on the beta, so Facebook will track like this black line here, a little bit above the S&P 500. It's only 0.28, a little 0.25% higher. So when it goes down, the same thing will be, you know, it will drop like a 0.25%, 1.25. So you get, if the S&P 500 moves 500 points, I mean, it moved 10%, you're going to get about 1280% increase. You get about 2.5, about 1280. You're going to get about 2% more than the movement of the S&P 500. Here we got a time lapse of 3 years monthly contract, and this is Facebook tracking for the last 3 years with the stock of Facebook tracking the S&P 500, and it will travel like that. So here we have 3,600 stock market and whatever it was, so it'll be a little bit higher. So we know this is 128. We know how Facebook is. And we already explained the other part of the bid and ask and so on, something that you need to look when you buy the stock and make your decision if you really want to buy that stock or not. Now we're going to move over here, and we got again the S&P 500, but now we're doing it 240 minutes, and we're going to track over here for several months, and now what we're going to do is to simplify it and make it look easier. We already know you take the beta and you multiply it by the increase of the S&P 500 in percentage, and you get what your stock should do. So if the S&P 500 go 10%, and your stock is 3%, so that means that your stock had gone up. It got a beta of 3.0. You multiply the beta times the 10%, so your stock has gone up 30% in price, right? So you have 100 shares, and the stock is $100 a share, so now it should be having about $129 to $130 per share on the particular move of the S&P 500. That's actually what beta does. So over here we got one that is 1.80, right? So it's greater than 1. So we're going to give it a price here, and let's say Ally. Ally we got on the black line over here, and this is how it tracks. So it tracks highly above, right? Because it got almost 2% above the S&P 500. We got over here Facebook at 1.28. So 1.28 for Facebook. So we put them over here on the red line, kind of to give you an idea how we know that it's exact back in here like that. Like I showed you a while ago, it's tracking like this. But to simplify the view of what we're talking about, right? It don't going to go like this. It's going to follow this by 1.28%, like I showed you before in the other black line. But what I'm trying to explain is that there will be the higher beta over here for Ally Bank. It will be much higher the line that it is for Facebook, So this is the symbol for greater than. That was for the guy that used to do algebra. You used to have all this stuff, in there. It's more than, it's not less than. Less than is the opposite way. So here we got a stock, whatever is XYZ or whatever, that have a negative 1.80, right? So is S&P 500 goes up 10%, right? You're going to get what? You got to multiply minus 1.80 times 10, and it's going to give you a number that is going to be much less than the S&P 500. Right? So one way to do it is if you were to multiply negative 80, right? A negative number by the 10% that went up, you will perform less than what the market was. So this is what is way down here, So it will track the same way, but down below this. It will zigzag through here, but much lower than the performance. So do you want to buy a stock like that? That your investment, the S&P 500 goes 20% in a year, but yours only going to go 1.8, so it's only way below that, and therefore your stock or your portfolio is underperforming the S&P 500. You're making less than others. The other one, as the S&P 500 go higher, and your stock got a positive number, 1.80 or more, therefore you will get a return on your stock much higher. So with that, we're going to look at this one again, So what I'm saying is that this is outperformed the S&P 500 because it even so it's zigzag up and down. Like here it is. This one is volatile stock. Sometimes goes up and then sometimes performing below that. Then it goes back up. So this is over here on our left side of the screen is the same chart, but the stock is moving up and down above the S&P 500, and you never know what this crazy deal will do. Right now we experience stuff like that, like with, I think it's Top Game or GameStop, a stock, it goes, they're on bankruptcy, but the stock goes up $300, go 300% or 700% just in 3 days. So that will outperform in any way the S&P 500, but that's not normal. And who knows who might get hurt here, who might don't get hurt. And fortune have been made out of this too. I have experienced that we bought an option 2 days ago, but I didn't like it that it was not moving, so I sold it and lost about $300. And guess what? This afternoon when it closed, I would have made $27,000. But that's the way it goes, I would have made $27,000. So a $2,600 option, because it was outperforming, the stock was outperforming the S&P 500 by the multiples of percentage in 2 days. This thing blew up from $2,600 to $27,000, but I sold too early, so therefore that's the way the cookie crumbles. So a stock that got less than 1, it will perform below the S&P 500, and the standard S&P 500 will have a 1, and then we make a reference. So that be the benchmark is 1 for doing this. With that, here we go, Tesla. Look at Tesla. Tesla is the same thing, $868 a share, up 22. But look at this beta, 2.19. And this is at the same time, look at how the price moved. The price moved $22, during the day or at that particular time. So let's see what we got here. So finally, now that we took care of beta, remember that beta is a stock that give me a number based on the performance for the S&P 500, that is 1. And the beta on the stock, you multiply it by the percentage, the S&P 500, and it should be, if it was 1.8, your stock will perform at 18%. It should perform 18% higher. S&P 500, 10%, so you're gaining an extra 8% that you have bought a stock that have a 1. And that's the whole idea. However, we don't have crystal balls. The data come from previous performance and prices. So we cannot, with that, predict that the stock will continue that. But when it's done, the formula is recalculated and then either go down, it's going to be less than 1.8, maybe go back down to 1.2, like some of them that we saw, and it's based on performance of the stock against the S&P 500, which should cover 500 stock from different sectors. So you get a better view. When we trade and we do day trading, we make sure that we put in our chart the S&P 500. We don't look at New York Stock Exchange performance. There's only 30 stocks in there, and I want to know how the overall market is doing, not just a few. So 500 and the Russell 2000, that's what we use for that. So now we're going to enter and combine the volatility. We're going to combine the beta on the stock, and we're going to combine the divergence that we have and derivative derived from the stock into options. So here where we begin with options. So at this point, we're gonna probably repeat or have a video here of what is an option and how the option behave. But before we do the video, I'm gonna show you this part. The risk of trading options, puts or call. Okay, there are very lot of forms to do this, and there are a lot of strategies. This is more advanced than this course. Okay, we do that too. We know how to handle that, and but we have to start just like everything else. Our journey starts with a single step. So in our journey to options, and combine it with the beta on the stock, performance of the stock, and S&P 500, is the mix and the strategy that make you a well-trained investor, a good trader that can become profitable all the time, probably about 98% of the time. Every trade you make, you will make money. If you don't have these things straight and well understood in your mind, you probably might lose a lot of money. And I can tell you about that. I've been through that road. I've been on this for now going into 49 years next month. 49 years of trading. That's a long time, almost half a century with 50. And I have seen a lot of things. People have taken advantage of me. Broker has taken advantage of my account, and nothing new. You cannot trust anybody. You got to be extremely careful, and I talk from my experience. If other people do better trusting somebody else, much luck to them, but I don't think so. Especially when they take 1% per year out of your account. So in 40 years, they have taken from your account 40%. So you're only going to get 60% of the money. But you say, well, I'm doing great. So yeah, but it's only one thing, that if they're taking away from your account 1% in 40 years, they have stolen from you. In the sake of service, 40% of what you should have. Oh, well, I got $100,000 on my account. Well, you got $100,000, but if you had done it yourself, you would have got $140,000 because somebody charging you a fee, he wiped out 40% of it. That's a good thing to understand about this. So the risk of option, right? So the risk of trading option, puts or the weather puts or call. And put mean that you expect the price to go down, and calls mean that you expect the price to go up. Now, let's say, for example, when I trade commodities, because we're going to see this in commodities too, when you buy, let's say, commodity for oil, you're going to trade oil and you buy a put, so you're expecting the price of oil to go down, and the contract is a contract of commodity. It's not a stock, right? So it's commodity now, so it's a contract for future delivery. So that's why they call it futures. And it comes at 1,000 barrels contract. So when you do that, that means that as the price of oil goes down $1, your option in theory gain $1. So you're making 1,000, right? But you don't have to pay for 1,000 barrels. You're just paying a fraction of that in an option contract. You don't have to buy the oil, or you can sell your option at any time, take your profits, and go home, and that's it. So the option writer, the guy that writes an option, right? The option writer can be a cover guy that owns the stock and a guy that is naked. By naked, it means that he don't own the stock and he's selling this stuff. So if something goes wrong, he has to make it up with cash. Nothing but cash will save his day. And right now, with this thing that go in the stock market with GameStop and stuff like that, a lot of the brokers are requiring that you have the cash to buy the stock. It's only one problem. They got so many contracts out there that they're not enough share to be covered if you were to buy it, So they don't want to get into that problem that they have to make up the money to you by themselves. And so they're going to stop that and say, hey, wait a minute, hold it right here. We don't want to, these people start calling the stock, and then we don't have there are more contracts out than shares available to deliver. Is everybody say, I want my shares from GameStop, they won't be able to deliver that. So therefore, what they're saying is, if you want to buy this call contract, we want to make sure that you got the money to buy the stock if something go wrong. So this is why people, well, I don't want to trade with my broker. He don't let me do what I want to. He's protecting you and protecting himself from a lawsuit. That's all it is. And there's some laws and regulations for the Security Exchange Commission that have to be followed. And if you don't know about that and you're trading, that you better learn, because there are a lot of surprises out there, and I learned it the hard way. So the option writer has the advantage. The advantage of the option writer is that he collects the money up front, 100% of it. If he's a cover call writer, he gets the money next day, and all he has to wait is for the time to wipe away all that money, because that money is not coming back. The option writer keep the money no matter what happened. So the guy that buy the option, he got problem. Because if the price of the stock don't go up, guess what? His money is gone. It's just like buying auto insurance. You pay $100 a month your insurance, and at the end of the 30 days, guess what happened? You don't get no money back. Oh, well, you didn't have no accident. You say, I'm sorry. It's $100 a month. So you have to write on the first of the month. Coming next week, you got to write another check for $100. So options are like that. The option writer got you by the neck. You got problems when you buy an option. You got to make sure that it goes in your right direction, or your money disappear very quickly, as we're going to explain later when we combine all these things together. The option buyer is a disadvantage. The price is always overinflated. And we're going to see about options being overinflated. Right now, GameStop, it got options that the volatility, because it's well overinflated, it's over 400%. But I tell you what happened. When that happened, what it does is that also increase profit for the exchange that is selling those options. So you overpaying anyway. Now you're really overpaying when you see that kind of volatility there. Implied volatility, that's what they call it in option. So that creates that the price is overinflated to create more brokers' commission. That's number 3. Number 4, option value don't match the gain value of the underlying asset once it's in the money. So the asset, it could be a stock, it could be heating oil, it could be lumber, or whatever an option is written, whether it is derivative or it is actually a future contract, it don't match what the price of the product goes up. And there's a lot of reason for those things. The option time value eventually decreased to 0 at the expiration date. So remember what I said about the insurance? In 30 days, your insurance premium is gone. The insurance company keep it. The option writer on number 1, he do the same thing. He write the option, he keep the money, unless he want to buy the contract back at a lower price because the price didn't match, or he bought it because he sold it because he know that the stock is going down, so eventually the option will expire worthless. But that's how it works. Finally, number 6, trading is nothing more than a name for buying and selling. It's just that simple. Okay? So with that, what we're going to do, we're going to move into the video for you. So understand their options.
What is an option? An option is the right, but not the obligation, to buy or sell the underlying futures contract at a predetermined price on or before a given future date. We make decisions every day for which there are options, such as what shoes to wear or what food to eat. By having multiple pairs of shoes or by having many menu items, you have options. Suppose your company is considering moving to a new city, and you may need to move. You could buy a house in the new city just in case, but that may not be the best use of your capital. And if the company decides not to move, then you have a house you don't need. But what if you could buy an option on a house in the new city? You will need to pay the owner for this right, and the cost of this right is called the option premium. If the company moves, you would exercise your option to purchase the house at the predetermined price. If the company does not move, then you would simply not exercise your right or option to buy the house. When this happens, the owner of the house will still keep the option premium. Options on futures work fundamentally the same way, but with more standardized terms. And like futures, options permit you to lock in price, but with an added layer of flexibility. For example, when you buy an option on a future, you pay an upfront premium and agree to buy that particular futures contract at a specific price. You have the right, but not the obligation, to exercise your option at that price and receive the futures contract. So if the prices move against you, you have the option of not exercising the contract. Every option transaction must have a buyer and a seller. Buyers pay the premium to the seller. The sellers hold the risk of price movement. What are some of the benefits of options on futures? Options can be used like insurance policies to limit losses on a futures contract. They can also be used for speculative purposes, whether you are selling options to receive premium income or using options to establish a position in a particular commodity, index, or interest rate. As hedging instruments, options can produce offsetting gains in the face of adverse price changes in the cash market. Options permit you to efficiently deploy capital in the form of option premium. In this case, you can participate in the price movements of the underlying asset without having to buy the asset outright. So when it comes to options on futures, both buyers and sellers have an array of choices to efficiently deploy their capital while expressing their opinion or managing their price risk in the marketplace.
Okay, folks, so here we're back again, and you saw how the option works, the opportunities in option on that video. And now we're going to look at the actual option. You are going to buy an option, right? You need to see several things and understand several things of that. So let me see if we make this a little bit bigger. Ooh, too big, eh? A little bit too big. Let's reduce it a little bit. Okay, we got an option here. Oop. Let's look at this particular option, and the price is in the money at 139, right? So the price being going up is 139. And we're going to see that the market maker say that he buy it for $5.25 per share, and he sell it, to you or me, whoever, for $5.40. So he making about 15 cents per share. 15 cents times 100, he get $15 plus the commission. Okay. And over here we got the open interest, how many contracts are open on that particular price at this time. However, here's the important thing that I want you to talk about it. Volatility. The volatility, implied volatility, they're saying that this price can go up almost 50% up or down. 50% that it can go up or it can go down. Up or down, Up, down. So is it possible that the stock himself will drop 50% right away? Or will go up 50%? Well, it's kind of impossible, especially we deal with Amazon.com, right? Amazon is $3,000 a share. Amazon will have to drop $1,500 to make 50% drop, or go up $1,500 on one day to have 50%, right? Or go down $1,500 to go down $1,500, or up another $1,500 for where we stand now. Those things don't happen. It might go up $60, $70, but not $1,500. But they're charging you for here 50%. Now here comes the other part. We're coming into the delta. The delta of the stock. This is what people don't understand. On the delta of the stock, what they're saying is how much delta means how much you're going to get per dollar that the stock goes up. Per dollar. So you never get 100% dollar per dollar. It's just that simple. You take, for example, here, the stock is at 139.07. It's in the money by 7 cents. So the stock, the delta is 0.53. 0.53 means that for every dollar the stock goes up, you're going to get 53 cents. The guy that owns the stock, he's going to get $1. You don't. Why? Because you didn't pay the price of the stock. You only bought an option that it only costs $5.40, and the stock costs $139 a share. So when you bought the option of 100 shares, you only pay $540. The other guy, $139, he had to pay $10,000. So he get dollar per dollar, you only get 59 cents. So you can see now that as the buyer, you are at disadvantage, because the stock had to go $2 up before you can make $1. But the guy that wrote the option, he got your dollars. He got you $540 per contract already long time ago. He got 100%. Remember what I mentioned? That the guy that wrote the option got the advantage? That's why. He got your money up front, and now for you to recover, you're only going to get half as a dollar move out. Right? So you could be owning the stock and write an option, so now you're a co-writer. Or you don't have the stock and you go naked because you don't have the stock to back it up, and you can write an option and hope that the price go down so you don't have to make up the difference. So now if we are out of the money and the stock has to go $142 before you start making any money, you notice that now it shows over here 50%. That's kind of strange, because now for every dollar that goes up, you're going to get 50, but this guy only get 49. But I'm not the one that calculate this. The other guy, I'm sorry. This is the volatility is 50%. The other guy get 49, and then the delta on $142 is 0.44. Because you're so far out of the money, you're going to get less money. For that reason, the option is also cheaper. It's only $4.20. You pay less, you get less. It gets into the money, you start getting more and more and more. So an option that is, let's say $5 in the money, they're going to get more than, they're going to get 65 cents per share. Because he already is about $5 in. So, but he never get to dollar per dollar. He get very close, maybe 87.90, 90 cents per dollar, but he never get to 100%. So you got a disadvantage no matter what. So that's one thing to know there. So as you can see, we just transition into options, and this is something to look. So we look over here, Facebook is $274.50, and if you are at 272, it's on the money, $2 or so into the money. The option now gets 63% volatility, but it gets 56 cents per dollar that it goes up. And as you notice, the option now, it don't cost $5, it costs $11. It's in the money. You see? Now this guy's over here, the one that get 670, at 282, but it's long way from being the money. So that's something that I see you there. The volatility and the implied volatility is very important, because as the stock get more volatile, right? Guess what happened? The beta also goes up. If the price going up even higher, that the S&P 500, they're going to give a higher number. But all those is formulated into all these things in order for you to get your reward or not reward into it. So let's look at the next slide. And here we got Flagstar Bank. Flagstar Bank, the shares is at $46. Very interesting, right? It's on the money, right? And in the money at $45, you only pay $3. But look at the implied volatility over here. Implied volatility is 295% on this one. This one 123%. The other one is 35%, So what's going on here? From $46 to $22, this guy's $20 in the money. The option is about $23 per share. Maybe he bought it a while ago, and he bought it for $2 or $3. But the implied volatility is 270, 265, 239%. How a stock that is $46 gonna lose 200%? 100% is zero. I can see going up that it can go from 46 to 120, but it don't want to happen overnight either, because that means it had to go up $80 or so. But they're already charging into this in 239%. So it affects the price of the option. I just want you to be aware of it. That's the thing. And you got to put, they even apply, some of them they applied over here on the right-hand side, 300%. Let's look at some of these options. Here you got GameStop, $85. That was yesterday, $85. As we're filming today, yesterday was $85. Today, when I have an option that I only paid $22 for, I paid about $24 right here, $24 for that option for a $90 stock. I sold it because it started losing value. It was 90 and now I'm down 5. And then today, as we're filming today, 24 hours later, that stock, that option was $27,000. I could cry in it. But that's part of the game. Sometimes we don't stay long enough, and then we say, man, it's only a state. We don't have a crystal ball. If I will have a crystal ball and realize that this ain't going to go up to $27,000 today, I won't be filming today this video for the library. They will have to wait. I was going to have and take my wife for dinner and maybe buy her a new car. I'm just joking, I got plenty of cars already. I don't need no more cars. But just think about it, from one day to another. But the implied volatility on these stocks is 500%. 500%. You're paying because the option now, right? The option that sold for $25 yesterday, now after jumping to almost $300 the stock, guess what? You have to pay $145 a share if you want to buy a contract. That's $14,000 for the same contract, right? For the same contract that I bought yesterday for $2,600. Now it's going to cost you $14,000 or $27,000 if you want to buy it. Because if I had sold that, I would have made about $25,000. Since I sold it yesterday, now I can cry. So I just want you to see the volatility in options, that is all not the same on all of them, and the premium and the delta are not the same in all of them. So always take that in consideration. Here's another one that it has 500%, and the stock is only $100 strike, but it costs, and you can buy it for $23, $25 per share on the option. It's not a $5. With that, we're going to move in of how the option work. Options work on this manner. You pay a premium, and we're going to describe this. We have described it probably before in other videos, but now we're really dealing in option. We were preparing you for this. Now we add this and review it a little bit more. So when you buy an option, and let's say that the stock was $40, is at 35 right now. Today is at 35, and you say today and the strike price is at 40, right? And you say, you know what? I don't want to buy it at the money, so I'm going to buy an option that is at $35, or I'm going to buy at 30, and it's going to cost you $5 a share. So one contract going to cost you $500. What we want to look is at the premium. The premium is very important, right? And what is in the money? This is where intrinsic and extrinsic value comes in. If we have beta on a stock, now not only we have the stock beta to deal with, right? When you're going to buy or sell that option, or how much you need to calculate that in there, right? So you say, hey, if this stock can go the beta and it's trending up and it goes 1.8, the stock can jump, 18%. So you want to make sure that when you buy the option, they're probably going to calculate that premium in there too, because the money that you can make. But the understanding here is about the premium. Remember what I said about the insurance guy? That you pay $100 and then a month later, $0, and you have to pay again. Where options premium behave like that. That's the intrinsic value. And then you're going to have other things that are going to go into this transaction of the option that we're going to see later. Okay, so you pay the $500, and this is 1 month option. So we divide it by the week. So the price of the stock is at $35. You bought a strike at 40, pay the $500, and a week later the price remained at 40. But your option premium has dropped to $475, right? So the difference between the 500 and 475, your premium had dropped $25. You say, oh, well, you can sell it right now and get it over with. Or you say, well, not much, I stay. You're going to find out that later on you won't be able to do that, because 1 week will kill you in no time at all. It's the time value. You're the time value on the insurance company for your car. 1 month for $100, you can say, well, that's about $3.25 per day. And it dropped 3.25 per day until this one day they only got 3.25, and then next day that's it, it's over. But options don't behave like that. It's not proportional in one way. It's not exactly the same amount day by day going down. That's not the way it works. It's proportional based in time, and as it gets closer, the time gets closer to expire, the faster it drops the value. It accelerates like crazy. This information is on the advanced courses. One of the little secrets about buying and selling options. I know a lady that she has sold options all her life, and she had made over $50 million doing this. She never bought a stock. She just wrote options. She didn't even own the stock. She got a lot of nerve, because something go wrong, you got to shell out a lot of money too. So now we go into the second week, and this is Saturday and Sunday comes here. Monday comes in, and guess what? Now the option is worth 450. Time decay, right? It's coming from $500 to $450 right here. $450. So this round figure, kind of round the square corners on this one, that is the premium. And this kind of octagon thing in here, or hectagon, 2, 4, 6, that's going to be the in the money on the option, that the stock is higher than. So on the second week, the prices start moving from 35, and by the end of the week, it end up $10 up. It's at $45. Wow, you are in the money now. That's very good. You are in the money. So we can see here that now the premium has dropped $100. Now it's only $400 in premium and $500 in the money. You add that together and your option worth $900. Okay, then we go through Saturday and Sunday, and Monday we come in and the stock go nowhere. So we cannot move this line up because the price remain at $45. And by the end of Friday of week 3, the premium that it was $400, now it has lost 50% in 1 week. Remember that in 1 week at the beginning, you only lost $25. And then on the other week, at the beginning of the week, you went down $75. Guess what? Over here, you dropped $200. You have $400 last week, and now this week, at the end of this week, you got $200 in premium, and still has the $500 that you are in the money. However, remember the $500 in the money, this is as an example that we use in a dollar per dollar. We know that the options don't go up dollar per dollar, but for simplicity, right? For simplicity, we say it's in the money $5. We're going to give you credit for the $500. We don't want to start calculating, well, an option that goes, oh, you get this much or not. That's not important. The important thing is that you understand that what you got in the money plus the premium, that's all you got left, right? So it lost value. You have start losing value. The extrinsic value of the option, the extrinsic, not the intrinsic, but the extrinsic value of the option is going away very fast. So we get over here now and we end up on the week of the 22nd, and this is the last week to trade. So here we are, here with the 22nd, the price still not moving. We still don't going nowhere, okay? So what happened is that by the end of the week, on the 26th, the option premium, it only got 25 cents left and $500 in the money, $500. We're going to take a quick break to take a sip, and then we'll return right away. Okay, we're back again, and as you know, still taking a little bit of Whataburger, by the way. It's a soda from Whataburger. A lot of people ask me, well, what are you drinking? Drinking Whataburger. No promotion. I don't get paid for that. Nobody get paid here for just mention it. Some of the local guys at the library, they also go to Whataburger on the bringing it from the classroom. So here we are. The option now is worth 25 cents on the premium and $500 on the stock. So what happened here that in the 27th, which is going to be Saturday, is very interesting because the option expires on June the 27th. But guess what happened? You cannot trade on June the 27th. It's Saturday. So the last day of trading is on Friday. So there's 25 cents there. You don't want to execute it. The only reason you're going to execute this order now is because you're going to sell it so you can get your $500 back. So you're going to get $525. You sell it. Now we got to say, well, what I did, they said, well, it cost you $500 for the premium, so you're getting your premium back plus 25 cents, and now we have to deduct from there the commissions. So let's say that it's $10 commission on this contract. So it costs you $10 going in, and it's going to cost you $10 going out, so it's $20. The federal government get 20 cents or 15 cents tax on that for that transaction. So that's another 30 cents, or let's say 25 cents altogether, 12 cents each. So you got only $480. So you went a whole month and you lose $20. And that's it, $20.25. Because of 25 cents on the premium, that the brokers keep that. The brokers, whatever is left on those is not returned to the guy that wrote it or anything like that. The guy that wrote the option, he already got 100% of his money from the very beginning a month ago. That's very, very important. You can see why the option writer has the advantage and the buyer is at disadvantage on he is up and ready to take action. The best time to sell that option was on the second week. That's why the option was $900. You will have got back your $500 and you will have made, right? You will have got your $500 back and you have made $400 minus 20, you will have made $380. But you get greedy, just like, now you can see why yesterday we went down and sold it, get out of it, and it was a bad thing. My entry point was not correct, and we don't have no crystal ball. So therefore, you will have make about $390 at this point, right here. That was the time. And the reason that it was like that is because further down, the premium was eating you away. You go from 400 to 200, and now in the last week, that's only worth 25 cents. All you got is the money that is in the money on the stock. The stock is at 45. Your strike price was 40, so it's only $5 in the money. So you got to be careful with the premium side. We're going to explain some of this stuff further down so you can see how it happened. Okay, so here we got a stock owner. The stock owner write the option on Friday the 8th, 2020. May the 8th. The stock is up 2.5%, and the last tick on the stock is $241. The option buyer on the other side buy the option and pay the $500 to the seller. See the price overlay. So what we're going to do, we're going to put the price of the option and the stock movement into it, so you can see what really happened. So you can understand what really happened. So here the stock price chart. The stock price moving along, and we're coming on the B side here. Friday the 8th, this is where we started, right? Right here, that's where we buy the option, Friday the 8th, and we're going to May the 8th. So we're starting right around here, someplace in here, and the price goes up, okay? So when we got into this part right here, you see, right here, we pay the $500 premium. This is where we pay the $500 premium. And in this case, the stock goes up, right? But actually, we're in the money, option price overlay. So the option is the red line coming around here on April the 6th. And by May, so we start here, and we end up down in here, May the 11th. I'm sorry, we bought it here, we get down here. So we pay the price, we buy it out of the money. The price, the stock goes up, and at this point, you know, the stock goes up, the premium is below the stock price. So we got the intrinsic value and the extrinsic value, okay? So the option intrinsic value, right, is gonna decay and it keep on going down as time get closer to May. You see, we got about 2 months, and now the whole thing start going the other way. The price, actually, the price only got so much value. So the combination of the option price and the premium on the option, all of them are together here in the red line. The option premium is going to be here. So what happened is that at the end of the expiration date, you know, last date of trading, May the 8th, the option premium, right, which is the extrinsic value, end up at 0. And all you got is $1.41, right? That's all it is. You just get there and that's it, you know. So we can explain this a little bit better when we go to this one. You pay your $500, the premium goes down eventually to 0. This is in 90 days, but notice what happened. The premium gradually goes down to 550, 450, 350, 250 here, 150, but notice that in 5 days it goes from 150 to 0. So you see, this is option time value deterioration, is called theta. 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 On the option, on the stock, is called beta, right? How it performed. Over here is the option time value deterioration, how it decay, is called theta. You see that on the option, so they tell you, you got a number there, so hey, this thing can move very fast. So the option fixed a specific lifespan is of 100 days, right? So you assume that theta has a negative influence on the option. And sometimes they put him on the, it's always a negative number. So when you look at an option contract, it might tell you that theta is minus 0.25. It never is positive. It cannot be positive because it continues to lose value. And this is what happened. You can then expect that tomorrow the option value will decline by 3%, right? i.e., 3.25 minus 25. So if the option, you know, is got about $3 that it's gonna go down, so it's actually 0.25, 3.25. So this is an option that probably, let's say, is $3 and a $3 option, and it have a theta of 0.25 negative, so that means that it's going to be minus 25. So you're going to have an option that is worth $3, right? It declined, the value will decline by $3, i.e. $3.25 minus 25 cents. So I had lost $3.25. So it always go down, it always goes down, and therefore we end up at 0. But the biggest amount of drop is right here. It gradually drops, but when it comes close to the end, this thing really can drop. Question is, can you trade at expiration date? And the answer is no. It's expired on Saturday, you cannot trade. Normally now they call it that it expires on Friday, but the settlement day is, you know, they used to, I guess for eliminate confusion, but that's before we used to read this on, and it's obvious that when you look at the day, say, hey man, that's on Saturday. You say, yep, Friday is the last day to trade, but Saturday is when all the accounts get settled. Then we also have what is called delta in the option. What is a delta on the option? You know, what option market makers do to you? Well, we already explained that. The option market maker inflate the price by increasing the volatility so he can charge you more. And then when you buy at the ask price and you sell on the bid price, we say. You always start negative. That's actually what I mean. We can see what you explained earlier, the seller gets $500 premium plus 500 from the stock. So the guy that wrote that option, he wrote the option for $500, okay? We did that, by the way, back in 2017 chart. So the guy that write the option, he get his $500 premium, and he's gonna sell it higher than what he paid for. So the choice, the buyer stock is at 45 or sell the option to close the contract. So the option buyer can anytime sell the contract, and the seller also can buy it back too if he wants to, and pay with your money, because if it go down too much, it's up, he can pay back into that. So actually, it goes down to $2,500, 0.67 value, 0.6737 value, 67 value plus 37 plus 5 is $92. This is all the stuff that's going to go in there. We don't worry much about that, but right here, they put in the 0.24. This is when they put the decay number in there, how it drops. So right here, got 0.24. Over here, 0.67, and keep on increasing on what you're going to get, and stuff like that. And eventually, we end up at 0. Now, we're going to look at the option that is on futures, but it's the same thing. And what is involved here, okay? On future, it could be oil, lumber, and stuff like that. But what I'm going to explain you here, the mechanics of it. Who is involved in all this stuff? So we're going to do this with corn, right? And we're going to take it from the producer. It could be a farmer. It could be a grower that grows corn, or a farmer, independent guy struggling with his tractor, planting that. This guy over here, the farmer, in order to plant the corn, he needs to buy seeds. This is highly regulated by a group of company that they kind of put genetic stuff on the grain to produce more stuff like that. But he could be removed from the market of selling his corn if he don't buy the seed from those people. He cannot grow his own seed. Crazy, but that's the way it is. Otherwise, the brokers and those that can move that corn will not buy it from him if it's not one of those type of corn. That's another story, but it's amazing what large corporations can do. So the farmer, he wanted to sell his stuff, he got a deal. So he can go to the bank and say, well, Mr. Banker, I'm going to plant 50,000 acres or 50 acres or whatever I got for corn, but I need money for buy fuel for my tractor. I had to pay the guy to plow the land. I got to pay the seeder. They're going to put the seed. I got to buy seed, so I need X amount of thousands of dollars. The bank lends him the money on the premises that the crops are going to be good and he'll be able to pay back his loan. If it's not, the bank comes in and take over the farm. Just that simple. So we create a special deal, option, right? Here come the devil, Look here, Mr. Farmer. Here come the future contract buyers. So the brokers come up with the futures and they go and tell Mr. Farmer, how many bushels of corn you're going to plant this year? Well, I'm going to probably plant, 2,000 bushels. Okay. Tell you what. How much you expect to get from that corn? Well, I plan to get $6 a bushel. So the farmer maybe cost him $4.50. He's gonna make $1.50 a bushel, and he's gonna have all the thousands of bushels. of corn to sell, and he covers his cost and everything else. After he paid the seeds, he made $1.50 a bushel. So he said, well, how much do you take? He said, well, if you buy it from me at $6.50, I sell it to you now. Okay, we're going to buy it from you at $6.50, and they sign a contract. That future contract in corn, he get the money up from just like the option guy, right? He write the option, he get the money right away. The farmer gets his money, he go and plant and sell and produce the corn. But now, the market at the exchange, guess what they do? They say, hey, we can insure ourselves from this, and we can sell option contract just like they sell on a stock. So now we got the farmer, the exchange and the market makers, and now we got the speculators and producers. Beautiful job. Everybody making money on the chains of command. So these guys sell futures, and somebody buy it, that the corn, say, both of them are doing the same thing. The guy that gives the money to the farmer or the growers, he expects that by the time, let's say that now it's May, and the corn be ready in November or September, by September the corn gonna be more than $6.50 a bushel, so he's gonna make some money. If the corn is not, the farmer gonna keep the money, and he can sell the corn on the open market for whatever he get. He already got paid for $6.50. He can sell it for $4.50. That's all the market share. He don't care because he already hedged his crop. On the other side, if a storm comes in and damages the corn, or the other corn producers, they get hit by a plague or whatever, and now corn goes to $8, he has to sell it for $6.50, right? And this guy gonna make money because now he bought it for $6.50, he can sell it for $8. But there's another guy here, the option guy. Well, this option could be producer, could be like distributor, wholesaler. We're gonna go through the whole chain of the corn. Packers, retailer, grocery store, end user, and you, right? So this guy turns around and say, you know what? I'm gonna buy options on this contract of corn, and if it go higher than $6.50, I'm gonna make some money. On the other side, the wholesaler, he wanna protect himself. He can come over here too and buy options, on the corn, and he can say, well, I'm gonna buy it for $6.50 from this contract. So all of them can come in here and buy from this guy that's writing the option. And when the corn goes to $8, they got to deliver $6.50, but they got that already from the farmer. No problem. Everybody protect themselves. Southwest Airlines do the same thing with jet fuel. That's why they're cheaper than anybody else. They buy jet fuel years ahead of time through option. So if jet fuel goes up, hey, they have to deliver it at that price. So when we get a distributor that bought the corn or whatever, that then the wholesaler can sell it for a company that pack corn in cans. The retailer might be around now, and they might be on the retailer side that buy from the packers and the wholesaler. It might be a guy that make corn tortillas. So he grind the corn to make tortillas. Other people grind the corn to make cornmeal. Cornbread and all that kind of stuff. Eventually, all that gets repacked and you go to the store. The end user is you, right? You and I go to a grocery store. We finally get the corn that this guy produced 7 months ago. And through the chain of command, now we pay for all this. We pay for all these guys in between. So when we go to a grocery store and we buy a can of corn, so we can put them on the salad tonight or whatever. That kind of corn has go through a lot. That corn has traveled a long way before it get to the table. So the end user is the one that covers the cost of all this and everything in between. So if something go wrong over here, he's going to pay more at the other end. And in between, all this guy making money back and forth with this deal. So we're going to look at something else, right? So the same thing happened with the stocks, right? A corporation, let's say that this guy manufactures furniture or whatever, and he's a private company, and he called J.B. Blank is the owner of the company. Mr. J.B. Blank eventually gets so big that he say, hey, maybe I become a corporation, IPO, and get my money out of it, sell the stock, and I'm still part owner and running the show, and I can take my profit that I worked so hard for all this many years. So he go to the bank, and the bank turn around and say, okay, you want to make an IPO? How many millions you worth or whatever? And the brokers and get to this, okay, we can sell this for you, just like they do with Apple, Facebook, and all that, but we want 6%, and we get you the investors. They get with the government, they get the approval, and an IPO is created, and the corporation forms, and Mr. Blank now, when he become a corporation right here, he's going to be the CEO, right? What I want you to understand is, at this point, that all this that take place in here don't have nothing to do with what's happening in the market out here. It don't have nothing to do with it. Once Mr. Blank get the money from his company, it's over. He don't have to pay you back. He just give you a piece of paper. If you get a piece of paper, because nowadays you don't even get that. You just get an electronic thing that you got so many shares of Mr. Joe Blank, J.B. Blank Corporation. All right? The bankers get their money here. The brokers get into this stuff here, and they say, hey, we get the investor from one end, investor put in the money, and what have you, and then we're going to create a secondary market and the stock exchange. So this is what I want you to understand about stock. When you buy a stock, okay, you're not buying it from the company name or the company. If you buy American Airlines stock, you don't buy an American Airlines for them. You don't buy the stock from American Airlines. You buy it from another seller that bought the stock long time ago and is floating around all over the place with electronic numbers. So the secondary market, right? The only way that these guys, the corporation now, will buy stock from you is if they go on the open market and buy back the stock. Like sometime Amazon say, we're going to buy back a stock. Apple say, we're going to start. Microsoft say, we're going to buy back stock to increase the price of the stock. They take it out of circulation, but they don't have to. If they go broke, this guy don't get the money. They go broke, they bring broke. You become part owner by proxy. If the company go broke, you cannot go and sue Joe Blank because he went broke, unless he committed fraud. Right? But remember when General Motors went broke? They just got rid of the union workers and everything else. And the stockholders over here eventually end up with $1.25 stock, and then one day it went to zero. And a new GM started at $25. Now it's about 40-something or $60. But the GM code is not the same GM that it used to be before. The old GM went broke. And those investors, they lost their money. Then they reissue new stock by the goodness of the U.S. government that bailed them out, right? Because we got to create jobs. We cannot let these people. Also, you, the taxpayer, finance GM birth again. That's the very interesting thing about this. So now GM is over here in the second market. So you go and buy stock shares, option contract get created, and you, the buyer, can go from here to here, right? You buy from the broker, you own the shares, and you can write contracts on option. So option contract, this is how the money flows. This is a derivative. The option here derive from the shares that are here, right? that somebody bought or owned for mutual fund or whatever, and then you can get options. You can set over here, you can buy options and you don't have to buy the stock, or you can sell options and you don't have the stock. Either way, you can own the stock right here, and then you write option contract from here to here. But regardless of what we do around here, this guy don't have anything to do with what we do anymore. If they do good, the value is calculated and say, well, the stock worth more. If you buy more shares and drive the stock up, this don't change the value of the company here at all. This is when we say that the company is overvalued. If this company were $5 billion or $5 million, and the stock outstanding stock price, when you multiply by the amount of shares that are outstanding, and the number is bigger than this, that's what the company worth, the stock is overbought. It don't worth that much money. One of the samples right now is what? GameStop. GameStop, it was a $5 stock going almost into bankruptcy, and this group of guys decided to start buying because there were a bunch of short sellers and drive the price in today to $300. Do that $300 make GameStop worth more? Of course not. GameStop is still a $5, $6, $7 stock. But people are willing to pay $300. Go figure. Somebody could get burned on this game. Those that were shorting the stock because they saw it was going to go lower, in the last 2 days, they had lost over $12 billion. $12 billion had been lost as of today, January 27, 2021. So when we talk about overpriced stock, you can make money on overpriced stock as long as there are more people willing to pay more than what it was. But eventually, it is in sinking and it's over, right? So we're dealing with a new market that can be kind of crazy nowadays, and it's good to know about that. Those guys don't have nothing to do with it here. The corporation here, the brokers got their money long time ago. The bank, JP Morgan, Bank of America, they help sell that stock. They already got their 6% commission. Just imagine when you take Facebook was on the IPO, and this banker collects 6% or something that he had no income. So you need to be aware as an investor and a trader how the system works. I'm not doing this for fun or making it complicated. All you need to know is that when you buy the stock, you don't have nothing to do with this guy. And if the company go broke over here for bad management, it reflects on the price of the stock. And they say, well, the price go down. Eventually, it might end up on the OTC, where anything goes over there. But you get out. You know, there was a time that MGM Casino used to worth $150 or $105 a share, and today only worth $30. And that's all it worth. You know, it don't worth no more. When you put the value and the debt that the company have, all those things will play into that. So now let's go and see about this one. I just want you to understand how this works. Okay, so we're going to go in here and we're going to do a second video. And then from here, that will be class. Let me tell you that this be the end of the lesson 4. And this is the understanding of the stock. We're going to see one more video, and this video is about more options. It's about options, and then we will continue on lesson number 5 with some more options and strategy. But for now, I want to thank you all for your time and to be here, and I'm glad to sharing my knowledge with all of you. and hopefully this will be of help to you to understand how the system works and what is involved. So always remember, when you buy stock, it's not the company that you're buying, who you're buying from. It's somebody else. It's the secondary market, and everybody cutting a cut here and there, making money out of it. And we participate in a big, giant market that can make many of you millionaires if you know how to do it, if you learn how to trade. So let's go into the video, and I see you next time in lesson number 5.
Understanding the underlying. Both futures and options on futures are called derivatives because they derive their value from something other than themselves. For example, a corn future derives its value from the actual underlying corn that can be delivered into the contract. An option on a future is no different, but the underlier is in fact another derivative, namely the corn future, which in turn has actual corn as its underlier. Option contracts span a variety of asset classes, from interest rates to equities to foreign exchange and physical commodities. Whether you are hedging a commodity position, writing options as a seller, or speculating on a particular commodity, the historical price action of the underlying futures contract will provide color for the expected volatility, which is part of what drives the value of an option. For example, if you're holding a gold option, you will have the opportunity to either buy, in the case of a call, or sell, in the case of a put, a gold futures contract at a specific price on or before the expiration. If you hold an S&P equity index option, then you have the opportunity to either buy or sell a future at a specified price on the Standard & Poor's 500 index level for a defined period of time. Holding a Treasury option, you have the right to sell or buy a $100,000 U.S. Treasury bond futures contract at a specific price during a certain period of time. In each case, the underlying derivatives contract determines the value of an options contract. When you set out to buy or write an option, doing your homework on the underlying futures contract will help you identify opportunities in the associated options contracts.